Welcome to our presentation on using estate planning tools that can help you and those you love while benefiting good causes. Let's start with something called a charitable remainder trust. If you listen to the presentation on revocable living trust, you have a pretty good basis for understanding charitable remainder trusts. They have some common features, but there are crucial differences as well. As with a living trust, you can think of a charitable remainder trust, CRT for short, as a basket into which you transfer things you own. But before you transfer anything, you need to understand why this basket is called a charitable remainder trust. Let's take it a word at a time. It's called charitable because eventually, a euphemism for when you and all other income beneficiaries of the trust die, eventually everything in the trust must be transferred to good causes. That doesn't mean that whatever you put into the trust is going to be transferred in its original form to charity. Gifts of real estate, for example, are almost always sold and reinvested in a diversified portfolio of stocks or cash instruments. These liquid assets are much easier and more practical to manage inside a charitable remainder trust than real estate. If you transfer stock and/or cash to your CRT, the trustee will almost always sell the stock and diversify and invest the cash. But no matter how your CRT gift is transformed through sale and investment management, whatever's left will eventually go 100% to good causes of your choice. That's why it's called a charitable trust. It's called a charitable remainder trust because only what remains in your CRT passes to good causes upon the death of all income beneficiaries. For example, let's say you have a rental property. You're sick and tired of being a landlord, so you transfer the rental property to a charitable remainder trust. The trustee then sells the property for, let's say, $300,000 and invests the proceeds to pay you and your spouse income for life. Upon the death of the surviving spouse, whatever remains in the trust is distributed 100% to the good causes you've named. All ultimate recipients of the proceeds from the trust must be IRS-recognized nonprofit organizations. Well, you can be sure that a figure other than the original $300,000 will be available to the charities. Like other investments, the value of what's in the trust is going to go up and down depending on the economy and depending on the skill of whoever is managing the trust assets. The good causes may get more than $300,000, they may get less. Finally, it's called a trust because it has the basic structure of a trust. Like the revocable living trust we discussed earlier, it's a basket woven of words into which someone transfers assets. Real estate, stock, and cash are most commonly used. As with any other trust, it needs a trustee, someone responsible for managing the trust assets, selling and reinvesting the original gift, for example, making payments to those named income beneficiaries of the trust, you and your spouse, for example, and finally, distributing whatever remains in the trust to the good causes you've named. Like any other trust, it has beneficiaries, almost always the persons who funded the trust, though they can name others, children, for example, to be beneficiaries. And like most living trusts, it has ultimate beneficiaries, in this case, the charities you've named. Those are some of the ways CRTs are similar to a revocable living trust. The biggest difference, and the one most important for you to be aware of, is that transfers to a charitable remainder trust are by their nature irrevocable. Once you've made the transfer, you can't get whatever you've transferred back. That would be like running down to your favorite charity and telling them you want your annual contribution back. Under normal circumstances, there's no way they can or will return your gift. So why in the world would you want to make an irrevocable transfer of a valuable asset to a charitable remainder trust? Well, as you're making this irrevocable transfer of cash, stock, or real estate to your charitable remainder trust with one hand, with the other hand, you're holding on to a very important right, the right to income, usually for life. Whomever you've named as trustee, and in certain circumstances you can be trustee, though your attorney may turn pale at the thought, that trustee must pay you income for life. Looking at your CRT from a strictly financial point of view, what other financial motivations would you have for doing this? Well, as soon as you transfer something of value to your charitable remainder trust, you receive a charitable income tax deduction, even though the good cause you have in mind has received nothing yet and may not even know that your CRT exists. You get an immediate income tax deduction. Why? Because of the irrevocable nature of the transfer. The IRS recognizes and rewards irrevocable transfers to charities. You must, however, follow IRS rules in claiming your deduction. One such informal rule is the IRS was not born yesterday. It can tell the difference between your giving something valuable with no strings attached to a good cause today and your setting aside something valuable in a CRT that must pay you income for the rest of your life and only after your death pass to good causes. So your charitable deduction from your CRT will always be less than the value you put in your CRT basket. But that doesn't mean the deduction will be small. Imagine someone who is only allowed to deduct 50% of a gift of real estate worth $300,000. That's still a $150,000 charitable deduction that you can use right away, even though your good causes haven't received anything yet. So assume your CRT gives you income for life and an immediate and sizable charitable income tax deduction. Are there any other financial rewards? Perhaps the major financial reward is the bypass of capital gains tax on any appreciated stock or real estate you contribute to your CRT. Say you bought stock or real estate a number of years ago and say it's now worth several times what you paid for it. You sell it conventionally. Who will be the first to congratulate you for your financial acumen? The IRS, of course, in the form of a tax on the capital gain, the difference between what you bought it for and what you sold it for. Sell that same appreciated stock or appreciated real estate after transferring it to your CRT, and your CRT bypasses the capital gains tax completely. The full sale proceeds, not the proceeds less capital gains tax, are there for the trustee to invest for your benefit during life and for the ultimate benefit of the good causes you've named. Lifetime income, an immediate income tax deduction, the bypass of capital gains tax on the sale of appreciated property, and a generous gift to good causes. Such in broad outline are the benefits of a charitable remainder trust. But don't act on this rough sketch of the mysteries of CRTs. If you feel there's a chance that a CRT can work for you or someone else you care about, or you just want to know more, Join me in our next presentation, Doing Well While Doing Good, Part 2. See you then.